Warning, world markets crash 50%. So I want to highlight a couple of videos that I've done recently warning about, well, the everything bubble collapse. I recently did this one, everything bubble collapse, including silver, where Kyle Bass had some wise words to say for investors in pretty much every asset class. And I really like this video that I did where George Noble really just, and I like George's character. He's a no BS kind of straight shooter guy. Doesn't really care about hurting people's feelings, and he said it how it is. And this video warning the everything bubble is over. And property crashed 25% this year. So this is 20-year property bulls turning property bears. And this video, don't fight the Fed. So this was from a few months ago now. And, this is the video where I realized that this whole inflation debate and interest rates has become political. I have a background in politics. And so, I see the political aspect of it. Raising interest rates isn't going to bring CPI down to 2% unless they raise, the old Taylor rule and raise interest rates above the CPI rate. Well, then we'll get a depression. Then we'll get a total economic collapse, and the financial system will melt down. And we'll have a deflationary bust. But you and I know that isn't going to happen. So I'll put links in the description to these videos if you haven't watched them. And if you haven't, please do so, because we're on the precipice of some very nasty things happening in all asset classes. And in the latest news, ANZ ups New Zealand interest rate expectations following inflation data. ANZ has increased its forecast for New Zealand interest rates following Monday's 7.3% inflation print for the country, or CPI print, the highest in 32 years. The lender said the higher than expected rise in consumer prices would extend a string of 50 basis point hikes to the official cash rate, or OCR, and open the possibility for the central bank to raise rates by 75 basis points in the upcoming meetings. We have changed our OCR call and now expect the run of 50 basis point hikes to continue through to November, meaning an OCR endpoint of 4% rather than 3.5%, economists from the bank said shortly after the New Zealand inflation data was released on Monday morning. A 75 basis point hike at the August meeting is a very real possibility, particularly if the labour market data on the 3rd of August delivers another hawkish surprise. So there's ANZ, one of the largest banks in New Zealand, saying that they're expecting the OCR, so the official cash rate, endpoint, to be 4% rather than 3.5%. So what are mortgage rates going to be in New Zealand? And we know New Zealand also have a big housing bubble, and, well, that's actually now coming off, and this is only going to get worse. But this is on the back of, the Bank of Canada. They raised rates by 100 basis points. They're sitting at 2.5%. New Zealand, with their 50 basis point rise, they're sitting at 2.5% as well. The Fed is expected to go at least 0.75, if not 100 basis points. So that'll take them up to 2.5%. We had the South Korea Central Bank just recently raised rates by 50 basis points, which is the highest they've ever done. Singapore, they recently raised rates out of cycle, so that's a big deal. And the Philippines also raised out of cycle by 75 basis points. And here in Australia, we got the RBA sitting at 1.35%. We're behind the rest of the world. We also get our CPI data quarterly, where most of the world get it monthly. So we really are behind. And I'm expecting the RBA to raise rates. With the unemployment numbers that came out for us, our unemployment numbers, all-time lows. at 3.5%. We've seen the minimum wage increase, 5.2% from memory. So that wage, that we've got sticky inflation now happening in the economy, not to mention all the energy stuff, which I'm not going to talk about in this video. So the RBA need to raise the dollar. The Aussie dollar is falling. And if they do not raise and keep up with other central banks, then our dollar is going to continue to fall, which increases input costs, increases the CPI, and it's just it's a mess. So expect higher interest rates coming. And here's New Zealand's house price update for June. So nationally, house prices are down 9.6%. Auckland, they're down 13.2%, and in Wellington, they're down 17%. All markets in New Zealand are falling much faster than the US did during the GFC. And here in Australia, we've got Sydney and Melbourne that have been falling for some time now. And for everyone that's been sprouting Brisbane, which is where I live, that's the place to boom, or that's the place to go. Well, Brisbane has now started to fall. And here from Livewire Markets, Christopher Joy, Brisbane home values start declining as Sydney losses hit circa 4%. And while we're at it, Christopher Joy has this one: Sydney house prices now crashing at more than 20% annualised rate. So whether it's New Zealand or Australia, with our housing bubbles, well, things aren't looking good. And interest rates, they've still got a lot further to go yet. And don't worry, to my American friends, you guys are going to enjoy the same housing problems that we've got in Australia and New Zealand, Canada. Here in Austin, the crash, well, it's underway. So we can see here inventory exploded by 2,132 in 1 month after going up by 1,690 in May, nearly 3 times higher than the previous record. And here from Zillow, we've seen a 3.5% drop in value in June in 1 month. That annualizes to 42% in a year if sustained. Well, nothing really works like that. However, this is the worst monthly decline on record. It's worse than 2008. And this is, other cities are going to be impacted as well. However, I know a lot of my American friends say that US housing is in a bubble. And yeah, look, it may well be, but it's nothing compared to Australia, New Zealand, and Canada. If the US is in a housing bubble, we're in a super bubble. And this from Harley Bassman that Zero Hedge retweeted. Last year, one could buy a $500,000 house by borrowing $450K at 3.25% for a monthly payment of $1,958. At a 5.5% rate, that same $1,958 monthly payment and $50K down payment can only buy a house priced at $395K. And I was chatting to my buddy Tarek Brooker, and I said to him, we had a client from last year whose maximum borrowing capacity was around $1,050,000, and should interest rates go to where the market are predicting, and I think I based his rate at 5.99, his maximum borrowing capacity was about $650,000. So as interest rates rise, as central banks continue doing what they're doing, that is going to destroy people's borrowing capacity, people's ability to be able to purchase higher and higher properties. So we see a big correlation between interest rates falling and borrowing capacity and loan growth and loan volume rising and house prices rising. we see a very good correlation. And so as house prices or as interest rates rise, we expect house prices to fall. And there's going to be a lot of people who are mortgage prisoners. In fact, we're already seeing it. We've seen some people that trying to refinance their mortgage, and they can't even service, based on the current rates now, they can't service their existing property, so they're stuck with that lender. They're a mortgage prisoner. They cannot refinance. And what will make things worse is if real estate does fall, those first home buyers that bought, especially in the last 2 years, are going to find negative equity, which once again, they're going to become mortgage prisoners because you cannot refinance with negative equity. So there's a lot of pain to come, in my opinion. And this from Tom Panos, who is an auctioneer and real estate influencer. I'm stressed. We had almost no buyers, yet I still think vendors should sell now. Here's why. Plus, John McGrath told me that 25 economists across Australia agree on this. The real estate market will get worse before it gets better. Now, these are all people, John McGrath, owner of McGrath Real Estate. These guys all have, I guess you'd say, vested interests that one could say I do too. We have a lending business that lends to real estate, to people buying real estate. But I'll always be honest with you guys. For these guys to say that they're stressed, that almost no buyers and that the real estate market will get worse before it gets better, is probably something to make note about. And central banks are really losing a lot of credibility right now. They're behind the curve. They should never have lowered rates to where they did. And now they've got so many people into so much credit, so much debt. We've got a huge debt bubble. And now they've got a inflation and a CPI problem. And, well, as I said earlier, the Taylor rule, if they're serious, they've got a long way to go in raising rates. But they are going to break something. They're going to break the markets. They're going to break probably the financial system if they do try to get anywhere near that CPI target. Now, I saw this chart, which was, quite interesting. I wanted to share. So if you take out the owner's equivalent rent part of the CPI and put in the true CPI using a Case-Shiller, well, the actual headline CPI would be 12.9%, not 9.1, 12.9. But if we're measuring apples with apples, the way CPI was measured in 1980, then CPI is over 17% now. And PPI in the US is the highest it's been since 1974. Now, you guys know that follow this channel what I've been talking about regarding the 1973-74 recession, where asset prices fell 50% in nominal terms. CPI peaked at 12.5% as rates were rising. And I do see something similar again. And look, CPI might come down. It might trend down to 8, 7, 6, maybe even 5. But then it's going to, in my opinion, it's going to shoot back up again. And we're going to have very similar type CPI readings like the 1970s. Nothing goes up in a straight line. So I think Jerome Powell will be found wrong that where he said that it's very, very unlikely the US will see 1970s style inflation. Well, it might not be so much bank credit creation style inflation, but there's going to be a lot of other similarities. And one thing I bang on this channel about all the time is energy. Energy is the foundation of an economy. It is the lifeblood of an economy. And here from the Bundesbank, Germany inflation metrics, well, Houston, we've got a problem. And I don't want to talk about energy on this video. I've done a whole heap. Go have a look at past videos. and have a look at a chart of CPI and oil. And here, global credit impulse weaker than the GFC by some margin. And this has a big impact on stocks' earnings per share growth. You can see the yellow, orange, I don't know, I'm colorblind, so whatever color that is, looks yellowish to me. 6 to 12 months later. So we've got a big problem with stocks when it comes to valuations. And here, the US Empire State Manufacturing Survey, new orders 6 months ahead just collapsed to levels only seen during the GFC and the tech bust. So from a economic, corporate, earnings point of view, we've got big problems ahead. And therefore, the stock market, in my opinion, is in quite big trouble. We haven't had a market crash like we did in March 2020, which created a liquidity event. But we are in a bear market. And this bear market, I talk about 1973-74 a lot. That was a 2-year period where the market went down 50% in nominal terms. So feel free to pause the video here if you can read all of this. Otherwise, Google the Dow Jones Industrial Average 1896 to 2016. I've found this really interesting. Now, this is a log scale, and it's just interesting. Something I've been talking about for a little while as well is when you're buying at these high multiples, these high PEs, then that means your returns moving forward are going to be much, much lower. And if our economy is getting damaged, because of the debt bubble and because of where interest rates are going, with government regulation, with what governments have done in the last 2 years, then companies are going to really struggle to continue growing their earnings over the coming decade. And, the recovery time, we don't know exactly how much this falls. The stock market's going to fall by 50%, like in 1973-74, maybe. Well, if so, that took 16 years to recover. Do central banks really push the envelope with interest rates, and we get a depression? We get a 1929 style stock market crash. Where people like Harry Dent might end up being right, where we get that 70 or 80%. Crash. Personally, I'm not in that camp. I'm in the 73-74 style camp, the stagflationary camp, where you do have recessions. You in the 70s, what were there? 3 recessions during that time period. It was very volatile. Yet we had high CPI. Yet the economy, the underlying economy, was weak, and so got to be very careful investing. Even at these prices, the market, even though it's fallen down from its peak and it's in a bear market, it's still, in my opinion, very expensive. Now, yes, I've done videos where I have shared that I've invested and I've gone back into the market a little bit. But I also did a video, investing lessons from Buffett, where I shared some of the things from Warren Buffett and some other investors, and how I've learned and my portfolio and how I invest. And how I look for value, deep value, the old cigar butt value type players. And, I saw that in 2020 with coal, saw that last year with oil, and now I see it in the metals and in some of the other commodity places. So you've got to be, if you are investing, this is where the value investors, this is where the really good stock pickers come into place. Simply investing in an ETF or an index fund, look, not financial advice, but good luck. And bonds have also been killed this year. I've been saying for a while now on this channel that I think bonds are the most disgusting asset class right now as an investment. And bonds are down 27%, which is the largest in 40 years. It compares with the 79-80 sell-off of 36% and the 80 to 82 38%. But the bond market isn't done yet. As rates continue to rise, yields go up, and therefore the price of those bonds go down. So this bond sell-off really, in my opinion, hasn't even got started yet. I'll finish this video with this meme. My stocks are down because of short sellers and macro, and slap, you paid 50 times sales. So we can come up with all the excuses as to why things are what, but at the end of the day, if we buy assets at all-time highs, at just record nosebleed type valuations, then we have to expect poor performance as we move out in time, especially in a rising interest rate environment, because all assets are valued and based off the risk-free rate, which is the US 10-year government yield. So, in my opinion, rates still got a lot more to move higher, which means bonds, they're not attractive in my opinion. Stocks, they're going to become, well, as rates move higher, they become even more overvalued. We've got economic problems and future earnings problems. What does that mean for stocks? It's not looking good. Property, well, once again, with the debt bubble, the leverage, with interest rates rising, we're already seeing the signs right across the globe that property is now starting to shake and well, starting to fall, and fall at quite significant speeds, much faster than the US during the GFC. And we've seen precious metals and commodities, well, they've already come off. They've already fallen. Yes, they could fall a bit more as the overall different markets continue to fall. But as a value investor, I don't trade, don't swing trade. I don't try to time the bottom and the top. I'm a value investor. I buy value. I see value. So what do you guys think? Where are you guys placing your capital? Are you holding cash? At the same time, CPI is eating your purchasing power. Are you in the stock market? Are you in property? Are you in bonds? Are you in precious metals and commodities? How are you playing this? Love to see your thoughts and opinions in the comments below. If you like this video, please guys, hit that like button. We really do appreciate it. Take care, everyone. I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor, having regard to your own objectives, financial situation, and needs.